time. Okay, well, welcome all to, this is our March completely virtual meetup. This is a meetup that, my name's Laura Caruso. I know some of you do not know me. I know John because of being a fellow fortune builder with real estate. We're located here in the St. Pete, Tampa part of Florida, and we focus on real estate investing and helping people in any way we can with connections or whatever anybody needs. And this is a meetup that we have every month. Sometimes they're completely virtual, sometimes they're in person and a hybrid model virtual. We've actually gotten to go to some properties that's had to just be completely in person, obviously, but I'm very excited to have you all here and learning about this topic that we have gotten a chance to talk to John and Leonard about and learn and just continue to learn about this way of approaching life insurance and how to use it. But before we get started because there are so many different people here, I'm just going to kind of go through if anybody wants to do, I don't want to call people out if they don't want to jump on, and just kind of give the 1 minute, who are you, where are you from, and you know what, just your little snippet. So let's see, anybody want to go?
I can go ahead.
Okay.
Hey guys, my name is Nolan Cornu. I'm a local wholesaler here in North Tampa. I met John Perry probably, what was it, John? Couple of weeks ago now.
Couple weeks ago. We'll be back next week, Nolan.
Yeah, awesome.
Yeah.
And yeah, originally from Boston, Massachusetts. Started in construction, but always been interested in real estate. My wife and I do Airbnb, short-term rentals. You know, we have one duplex. So really just looking to build a portfolio here and then help all of you guys out as well as far as finding deals in the Tampa area. So yeah, that's me.
Thank you so much for sharing. And then I just had a question asked, and this is something that maybe as we're just going through this meeting, if y'all want to, if there's people you want to connect with, kind of just drop your contact information in the chat bar as we go.
Okay, I can go next. Hi, my name is Naomi Corponin. I'm from Honolulu, Hawaii, and I met John approximately 9 months ago, I think it was, last June. And I am also with Fortune Builders, but I haven't really did any flips on my own with Fortune Builders because I had my own brokerage firm, and I thought it was like a thin line between flipping properties and whatnot. But I just put my company in inactive status to join EXP to see what we got, what we can get started, right, John? What we can do, build wealth.
Sure.
Absolutely.
So
Thank you for sharing.
Naomi on the team too. For those who don't know, I have my license with EXP as well. Yeah, so thank you, Naomi. It's good to see you.
Yeah, good to see you.
Anybody else want to jump in? Just give a quick snippet.
I'll go real quick. I'm Cliff Cower. I'm from Pittsburgh. I met John at a Fortune Builders event actually about, what, 2008, 2009, something like that. But we've been doing some stuff together here and there in Pittsburgh. So I will be coming to Florida with him again. Next week?
Yeah.
Awesome. We're a fellow Steelers fan then. We're actually from Pittsburgh, the Pittsburgh area originally. So I appreciate your weather there.
Fellow Yinzers.
Yes, fellow Yinzers. I know some. Oh no, I know you're dying to share with us.
Hey Laura, good to see you again.
You too.
Hey everyone, my name is Aldo. I'm based out here in Southern California, between LA and San Diego. I've been focusing on flipping properties since 2013. I've had projects all over Southern California and Florida as well, right? Right, Laura?
Yep.
and so right now I'm still focused on the flipping side of business. And we have a couple projects going on right now here in the LA area, but also focusing more on the short-term rental side. And and creating partnerships with different homeowners on their properties and running short-term rentals out of them. So yeah, that's currently right now what I'm working on.
Thanks so much, Aldo. I know my husband wants to introduce himself.
Yeah. Hi, everyone. John Caruso here, Laura's husband. Yeah, the other half of this duo, and nice to see some familiar faces, and also nice to see some that I don't recognize. So thanks for hopping on.
Thanks. Anyone else? All right, I don't want to put anybody else on the spot, but I do want to go ahead, and I know there's so much information to cover, so I'm going to go ahead and let, as I said, I know John because of Fortune Builders and fellow Pittsburgh Yinzers. So we were connected. Actually, I think, John, wasn't it during COVID, I believe, when we all had to go into this virtual model, which that was the positive, I guess, not that there were a lot of positives of COVID, but we were, instead of just doing in-person meetups, we then started this virtual model, and that's how we were able to connect and then continue the relationship. And it's always awesome to see John and his team coming down to Florida and the things that they're doing here. And then and obviously what they do in Pennsylvania as well. So John, I'm going to let you go ahead and introduce Leonard and your group, and take it away.
Awesome. Yeah, thank you, Laura, and thank you, John. Appreciate you hosting this for us. Yeah, so anybody here that is doing any fix and flips or rehabs, you're gonna love what Leonard has to share. So we've been kind of putting our heads together. Leonard's got 14 years in the financial services space, has been doing some really cool things with life insurance, and so, you know, I put my 20 years of real estate experience, and with his brain on the financial side, we came up with something that I think you guys would really want to learn more about. So definitely take a lot of notes, because I don't know anybody that's kind of doing this, but you know, we're so close with technology and with advancements now that we can almost replace the need for a traditional banking system, which could be a good thing, but I don't want to ruin Leonard's thunder. So yeah, just get ready to take some notes here. I think you guys will like this. So Leonard Cabral, my mentor, my friend from Hawaii. We were down in Tampa and Orlando a couple weeks ago. We will be back on the 24th. We have an event coming up in Tampa on the 26th in the morning, and then Orlando in the evening. So it's gonna be one crazy day. But we just love sharing information with people and helping people to get ready for when the market shifts and you know, when changes happen, and you know, especially with everything going on digitally and virtually now. So Leonard, take it away, man.
Awesome. Thank you. Thanks, John. Thanks, Laura, for allowing us the opportunity to just come on your, you know, this meeting and just be able to share with people. I mean, you know, this is what I love about what we do. It's not really about trying to sell anything to you folks. It's really just education and showing you folks a different way to do what you already do. Okay, so just know that this is not you know, trying to get you guys to do anything other than just expand your brain into a different way of thinking and a different way of doing business. And so I was working all day with John today on this, and actually, John, I added a couple more slides because I was resting, and a couple of things just jumped into my head. So hopefully it'll make sense. But guys, this presentation, I think, is gonna really change the way you do things, because it's all we're gonna do is I'm gonna show you just adding one more piece to the puzzle. That's it. You're going to continue doing your normal course of business, but by adding one more piece into your strategy, it'll take your game to a whole different level. Okay, so with that, here we go. Here's my disclaimer. I'm not here to give you any type of legal, accounting, or tax advice. If you need that, go see a tax professional or CPA. This is just for information purposes only. And everything that I'm sharing with you tonight is just my personal opinion on how we do things. There are other people that do things slightly different, okay? So this is what we're going to basically talk about: the flow of money, a different banking strategy, and then we're going to go into an actual case scenario. But by the way, Laura, how much time do I have? What time do I, is there a hard stop or anything?
Yeah, no, there's no hard stop on it. And I guess this is where what we had talked about. Do you want, since we do have like, you know, a decent amount of people in this group, that as they have questions, just put them into the chat box and we'll get to them as needed.
Yeah, that'd be good. So yeah, if you guys have any questions, just put it into the chat, and then John or someone, yeah, John will, and if he can't answer a question, then he'll just interrupt me. And that way you folks can, because I don't want you getting stuck on something that I'm talking about. You know, just ask a question, and John will help move it along as quickly as possible. Thank you for the reminder, Laura.
Oh yeah, you're welcome. Yeah. Yeah. So there's, whatever you need to do time wise, we're here.
Okay, cool. So here's some questions I want you to think about as I'm going through this presentation. Actually, before I go into the presentation, how would you feel if one, you didn't have enough money to retire on? Number two, you could create a tax-free retirement income. Number three, if you could have your assets work for you. And lastly, what if you could turn your rehabs into a tax-free income? Okay, I mean, again, these are things that we're going to be talking about, and I really want you to again, and the key word here is tax-free, right? Because the question I ask every single person is, you know, do you believe taxes are going to go up or down in the next 10, 15, 20 years? And for most people, they feel taxes are going to go up. So why not use the tools that you already have handy to you and use it to create that tax-free income for yourself? Okay, so here's a scenario, the key scenario that we're going to end up with, and I'm showing it to you now so you know what we're driving towards. Okay, we're going to use a 45-year-old male. We're going to create positive arbitrage. What arbitrage is just the difference between what you borrow money at and what you're able to make from it, right? So basically, how much do you buy your money and how much do you sell it for? And the difference is arbitrage. If you're buying it for more than you're selling it for, then you're negative. If you're selling it for more than you're buying it for, then you're positive, right? This strategy is a net cost zero strategy, meaning we're not going to actually ask you to come out of pocket a penny to make this happen. You're actually through this strategy, you're actually going to earn $500,000 of tax-free income. That is correct. I'm not even joking. This is $500,000 tax-free income every year for the rest of your life. Okay, that's why John was so excited when we're working on this. He's like, "Holy cow, this is a full-on game changer." But I'm also going to show you, not only do you need to borrow money from private lenders, but eventually you'll be able to use this policy to also finance your own rehabs. Okay, so in the beginning, you're going to be using a private lender, and at some point, you'll have so much cash inside of your policy that you won't need to use private lenders if you choose to. Right, and then this also serves as a natural asset protector. So here's a quick, sorry, jumping ahead of myself. The four pillars to every financial plan, whether you're aware of it or not. Cash creation is just how you make your money. So you're all in the real estate arena. So that's how you earn your cash. Number two is cash capture. Where do you store your money? This is important because for most people, they store their money inside of a bank. And what do you get from a bank? 0.25% if you're lucky, right? And most people don't use a bank for anything more than that. And so I want to shift your mindset. I want you to change the way you look at banks. Okay, you know, I want you to look at a bank as a private, a public storage unit. That's it. You know, those big orange buildings down the street from you, that's all it is. It's just a storage unit. And so the question I have for you is, if I can show you a more efficient storage unit that gives you a better rate of return, gives you access to your cash, allows you to collateralize your money, gives you tax deferred growth, gives you tax-free income, gives you additional benefits like a death benefit and living benefits, also serves, protects you from lawsuits, right? Would you be open to hearing how you can just change your storage unit, nothing else, just change it from a storage container that's giving you 0.25% and that's it, to a more efficient storage unit? And I will tell you, if you answer yes to that question, at the bottom of the basic of what we're talking about today, that is all we're saying. Okay, is I'm going to show you how to create a more efficient storage container. Okay, cash flow is again the difference between, you know, how much you spend and how much you earn. If you spend more than you earn, you're positive. Maybe if you spend more than you earn, you're negative. If you earn more than you spend, you're positive. And then cash control. This is important. Who's in control of your cash? This is why I do what I do, because I want to teach people how to be, you know, how to educate yourself and how to be more in control of your money. Because here's what I know: no one's going to care more about your money than you. Period. Right? So if that's the case, then shouldn't you, I mean, you guys are already on that process. You guys are all real estate investors. So you understand that more than most people that I talk to. But I love this because I get to empower people and give them additional tools to create their wealth. So here's a quick video I want to play just to get you guys to understand what we're trying to accomplish. Okay, so this video is gonna is just a concept. It's not a product, but it's gonna explain to you you know, how the money flows. Okay, so here we go.
It's been said that compound interest was the eighth wonder of the world, and it could be the one thing that has the most to do with your financial success or failure. A fundamental premise of compound interest is that it works best over time and without interruption. The private reserve strategy will give you insight into how to maximize the power of compound interest, not only in the money you're saving and investing for your retirement, but how you spend money as well. What is the private reserve strategy? It's a concept, an idea, a way to look at how money works. It's a strategy designed to help you develop or improve your financial position by avoiding or minimizing unnecessary wealth transfers where possible, and accumulate an increasing pool of capital you can access and you control. Some transfers are avoidable, others you can only minimize. An example, for most of us, owning a car is an unavoidable expense. How we pay for the car can help to minimize the expense, meaning that some methods of paying for the car could be better than others. You finance everything you buy. You either earn interest or you forego earning interest. You might be saying to yourself, I don't finance, I pay cash. The reality is you too are also financing, because you must make payments to yourself to get back to the same financial position you were in before you made the purchase. A key point to understand is that every dollar we do not save is consumed and lost forever. You may be able to put the money back you spent from future cash flow, but the money you spent is gone and can't be recaptured. Let's take a look at the cost to buy a car. When you buy it, you lose the money you pay for the car. You also lose the interest you pay on the loan, and you use what the interest could have earned you had you been able to invest the interest you paid. This is called opportunity cost. Remember, if you paid cash, you no longer have the money you spent for the car, and you lost the interest the money could have earned had you been able to keep it. So, let's say you bought a $30,000 car at 6% for 60 months. Your payments would be $579.98 a month for a total of $34,799, and you would have also paid $4,799 in interest. Let's say you can earn 6% on your money and that you're trading cars every 2 years and have 40 car buying years left. As you can see, you'll be financing 20 cars over the period, and had you been able to invest the interest you paid, you would have had $463,203, assuming a 6% return. We're not saying you should not buy a car, but rather that you understand the cost. No matter how you look at the price of owning cars, it's quite expensive. The private reserve strategy can give you a method to minimize the loss and maximize your purchasing power. The point we're trying to make is that before you make any purchase, you must not only consider the cost, but the opportunity cost as well. It's not just what you buy, it's how you buy it. There are 3 ways to make major capital purchases like automobiles. The debtors have no savings. They're not earning any interest, so they're forced to pay interest. The savers save. They earn interest on their savings dollars and they pay cash. There's another option which we call the wealth creators. They save, they earn compound interest, and they collateralize their major capital purchases. Collateralization simply means they pledge a portion of their money as security for an amortizing loan against their cash position. Their money is still earning interest while they're paying interest. Let's look at an example of all 3 positions. This is the zero line. It signifies a financial position where one has nothing and owes nothing. Zero. Let's look first at the debtors. They have no money, so they're forced to borrow against their future and go below zero. They make payments of both principal and interest, working their way back to zero. Unfortunately, it's easy to find oneself trapped in this position. The next position are the savers. They postpone gratification and put money away to be able to pay cash for their purchases in the future. Then the day comes that they must drain their account to make the purchase, and they find themselves uncomfortably close to the zero line, so they begin saving again to ease that tension. Finally, let's look at the wealth creators. They've been saving like the saver. However, when it comes time to make a major capital purchase, they collateralize the purchase, meaning they borrow against their capital and pay off the lender while they continue to compound interest on their money. As you'll notice over time, they, like our other 2 examples, made the same purchase, paid off their loans, and continued receiving the benefits of compound interest along the way. We all understand that debt is a problem. What is debt? Debt is borrowing money to purchase something that you can't pay for in full with your monthly cash flow. A debtor is someone who has the intention to repay, but does not have the ability to pay in full at the time of purchase. The problem with debt is you have a future obligation against your earnings, which you may or may not be able to fulfill. You lost the money you spent, plus the interest you had to pay to get it. You are now a debtor to the creditor, and you have no control over the money you're spending. Debt is not an efficient purchasing strategy. Okay, if you're not going to go into debt to buy things, what strategy will you have to use? Pay cash, right? What's the problem with paying cash? This seems like a silly question at first. If paying cash for your car is the answer to avoiding going into debt, where's the problem? The problem has to do with compounding interest or the lack of compounding. To pay cash, one must first save. Once they have sufficient funds to make their purchase, they must now deplete their savings or drain the tank. Remember, while the money was in the tank, it was compounding interest. By paying cash, they do not owe interest. However, they are no longer earning interest on the amount they withdrew. They have reset compounding on that amount of money. To get back to where they were before, they must put back what they withdrew from the tank, plus the interest they lost that they would have earned as well had they left the money in the tank. What makes filling the tank even harder to do is that any interest you earn on the money you have in the tank is usually taxed as it's earned or on withdrawal. Don't forget, compound interest works best over time without interruption. Paying cash is not bad, but it's not the most efficient purchasing strategy. Back to the real problem, which is that when you drain the tank, you're resetting compounding on that amount of money. When we pay cash, we do save interest, but we should also consider the amount of interest we're losing by doing so. Let me give you an illustration. Suppose you have $50,000 in your tank. You're earning 5% interest and you're going to look at the results over 30 years. You're going to drain the tank at the beginning of the period and you're going to put the $50,000 back over 4 years. Had you not drained the tank, it would have grown to $216,097. Draining the tank one time and putting it back in 4 years and allowing it to compound the remainder of the period, 26 years, will only grow to $177,784. To drain the tank once costs $38,313. You did save interest, but you also lost interest. How many times do you want to reset the compounding cycle? Let me introduce you to the private reserve strategy. Remember, the private reserve strategy is not something you buy, but a concept you employ. It's a strategy that gives you a way to solve your need for capital while you're saving for your future. How does it work? You have money in an account which we're going to call your private reserve. It can be any account of your choosing. You want to make a major capital purchase. Let's assume you want to buy a car. Rather than draining your tank to do it, you secure a loan from a financial institution against the money you have in your private reserve account. The institution gives you a check for the amount you have borrowed and you make your purchase. You now have an amortizing loan with the institution and they have a collateral position against your private reserve account. You'll pay the institution interest, which is declining, while the money you have in your private reserve account is earning interest that is compounding. The goal of the private reserve strategy is to increase long-term efficiency by leveraging the differences between amortized payments and compounding interest. Let's look at an illustration using a $30,000 car purchase. Let's assume you had to pay 5% interest on the loan over 5 years. Your monthly payments would be $566. At the end of the 5 years, you would have paid $3,968 in interest. If you had $30,000 in an account earning 5% for 5 years, you would have earned $8,501 in interest while you were paying $3,968. To be correct, you must also calculate the interest you are losing on the amortized payments as you go. Any interest paid is interest lost. The faster you pay the loan, the quicker you reduce the lien on your private reserve account, increasing your efficiency. The private reserve account can be any account you want to use. While you will want to find an account that gives you the greatest number of benefits, the one benefit that the account you choose must have is that your money must be available through collateralization. When looking for a vehicle to serve as your private reserve account, you're going to want to look for an account that has characteristics and benefits that meet your needs. Well, let's talk about some of those. One of the things you're really going to want is tax-deferred growth on your money. Compounding interest in a taxable account is not going to serve you very well. Tax-free distribution would be awesome, to be able to get the money out without paying taxes. You would like to get a competitive rate of return during the accumulation phase when you're putting the money in the tank. You would like to put in as much as you want, thus having high contribution limits. Deductible contributions would be preferred. Collateralization opportunities is key. Remember, if the account you're thinking about will not allow you to collateralize, thus forcing you to drain the tank, that account will not function well as your private reserve. A safe harbor. You want the money in an account that's safe. You would prefer no loss provisions, meaning you can't lose this money. You would also want guaranteed loan options. If you're going to collateralize loans from time to time, you're going to want to be able to do it at your discretion with guaranteed access. Unstructured loan payments would be preferred, meaning you do want to pay the money back, but you're not under any obligation to do so on a set and rigid schedule, thus eliminating the pressure of forced payments. You would want liquidity, use, and control of the money at all times. And then finally, additional benefits like creditor proof, meaning your account is protected in the event of a lawsuit. While many accounts will work as a private reserve, there are some that will work better than others. In addition to the ability to collateralize, the private reserve account must also be safe, meaning the money you put in this account cannot be lost. The private reserve account would not necessarily be an account to replace your investment accounts, although it can also help you be more efficient in that area as well, but rather an accumulation account in addition to your investment holdings. Let's recap. We finance everything we buy. We want our money to earn compound interest without interruption, meaning we never want to drain the tank, and collateralizing our major purchases is a more efficient purchasing strategy than going into debt or paying cash. To learn how you can employ the private reserve strategy.
That was just a quick what do you call recap? I mean, understanding of how the money flows. Okay, so it's basically you're just using a life insurance policy as a pass-through account, and that's all it is. Okay, a holding tank is what I call it. And so when your money is not working in a deal, you would I'm going to skip this other video. I'm not going to play that video today. But when your money is not inside of a deal, you would leave it inside the life insurance policy where it's still going to be earning you on average 8% per year. Okay. And then when you're ready to get into a deal, your money is now liquid to you and ready for you to deploy it. Okay. So the money is always accessible to you to take down deals anytime you want. Okay. And so that's why when I was talking about when you're looking at a bank and you're looking at it as a storage unit, all we're doing is putting a life insurance policy in place to serve as your new storage unit. That's all it is. So it's just a place that you're going to leave your money there when you're ready to deploy it, whether you're going to lend it out as a hard money lender or you're going to go into an actual deal. That money is ready for you to deploy. And then when the deal is done, you now have a place to bring that money back so that now it can continue to earn again. And now watch this. This is one of the magical things. I'm not sure if I have it in my slides. I'm just going to talk about it right now. When you deploy that money, let's say, actually, no, I do have a slide. I'll get to that when I get there. So this is how we currently bank. And for most people, all they do is as they earn their money, they put it into a bank, right? And then when they get ready to pay their bills, they move it out and they pay their bills. Simple. Okay. The problem is the storage unit isn't giving you anything. So therefore your money is no longer compounding. Every time you drain that tank, you're losing the compounding ability. Okay. And so this is how we should be banking. So now you earn your money, you still put it into a bank, but now you're going to add one additional tool, a private reserve account, and you're going to dump your money in there. And then when you get ready to then pay your bills, or in your guys' case, to do your rehabs, you're going to then deploy the money from your private reserve account and move it into your rehabs. Okay. So simply by adding that life insurance policy, again, nothing else changes for you, except now that becomes your holding tank that is now, number one, giving you a better rate of return, giving you access to all that cash. Again, and I'm not sure if you guys heard it, but you have unstructured loan payments in using this vehicle. So again, not that any of you ever run into a situation where you have to, your projects run overboard and, go over the 6 months or 8 months or whatever it is. And now you incur additional costs to the private lender or to the bank that you borrowed the money from. In this scenario, when you borrow that money from your life insurance policy, and if your project goes over, goes longer, well, you don't necessarily have to pay that money back until your project is done. Okay. And that's a huge benefit because as you already have enough stress going on. This just allows you to work the deal in its most efficient manner. And then when you're done and the project sells, then you go back and you put it back into your life insurance policy. So here's the assumption that we're going to make in moving into the next slide. This is a 45-year-old male, non-smoker, fairly healthy. And I'm going to just show it to you on one fix and flip per year. Okay. So some of you, I know Laura, you guys do a whole bunch more than just one per year, but this is based off of just one per year. Okay. And partly is because our software is not robust enough to do more. Okay. So just know, it's one. We're using you're going to purchase a property for $300,000 and your rehab and your holding cost is $200,000. Okay. So this is what it's going to look like. I'm sorry. This is one of the slides I added. So this is how you currently, when you're doing your flip, this is your current situation, right? You have that same scenario, right? $300,000 purchase of the house, and you're going to use $200,000 for renovation. You go to your private lender. He loans you $500,000, right? From there, you purchase the home for $300,000. The other $200,000 you deposit it into your bank, which they give you a whopping 0.25% to leave it there. Then when you need to, you withdraw $200,000 to rehab your property. And then at the time when you sell the house for $800,000, you're going to pay back the private lender of $550,000. And then you're also going to put $250,000 back into the bank. Okay, this is typically what you guys are doing. Now, let me show you. We're going to, again, simply by changing one thing, Okay, how this is going to make a major difference for you. Again, same private lender, same $500,000. Okay, you can purchase the same home for $300,000. The difference is now you're going to put the money into your policy, your life insurance policy, or your private reserve account. Now you're going to borrow from your life insurance policy, the $200,000 to put into the house. Now, I don't want to get into specifics about, because I'm just trying to create a general visualization for you folks. When we sit down, if this is of interest to you and you want to know the details and all the little nuances, when we sit, we can do a one-on-one with you and we can go into more, we can dive deep into it. Okay, to the last dollar. Okay, so you're going to borrow the money from your life insurance policy, but remember this: when you withdraw the money from your bank, that money is gone, so you're no longer earning interest. But when you do it from your private reserve account or your life insurance policy, that $200,000 is as if it's still sitting inside your life insurance policy. So on average, you're still going to be earning 8% on that money that is sitting, that $200,000, you're going to be earning 8%. Yes, when you borrow it as a loan to do your rehab, you will be paying 4% interest. But guess what? You're still net earning, again, your net positive 4% arbitrage. So at $200,000 that you borrowed, you're still earning 4% interest versus when it was sitting inside of a bank, you was earning nothing. Okay, this is how you earn compound interest. Then what you're going to do is you're going to turn around when you sell again, you're going to sell the house for $800,000, no difference. You're still going to pay back the lender $550,000, but now you're going to put the $250,000 back into your policy. You just paid for a policy using someone else's money, funded your rehab with the life insurance policy, and put the money back into the life insurance policy, all at no cost to you. Not a single penny came out of your pocket to make this whole thing work. Okay, but watch this. Here's some highlights that we want to show you. As a borrower, there's no monthly payments you have to make in this strategy. Right, you're using a low interest loan from the life insurance policy. Okay, it's 4%. There's no bank qualifications to borrow that money. It's, again, you have first rights to that money. There's no cash outlay for you. There's no credit checks. You're building cash flow as you're doing this strategy. You're also building equity inside your private reserve account. And I'm going to show you that on the next slide. Okay, or maybe a couple slides down. You're also creating leverage. You're protecting your income. You're protecting your assets. And at the end of the day, you're creating a tax-free income. Okay, this is the game changer. You're creating tax-free income. Now, what is the benefit to the hard money lender, to the private lender? Well, number one, they get a mortgage, they get a promissory note, and they obviously they get the PNC insurance. But watch this. Can you imagine if now you was able to give them a mortgage insurance? If you were to tell your private lender, or if you are a private lender, what if you now say, hey, I need you to get a lot, let's talk it from you, the borrower, the real estate investor. You can now go to your lender and say, hey, I want to borrow $500,000, and if anything happens to me, I'm going to collateralize $550,000 back to you. So no matter what happens, you're going to get your money. Do you think you just put yourself in a better position than everybody else out there that is looking to borrow money from this private lender? You're solidifying your spot. You're separating yourself from the herd. Right now, the risk to that private lender goes way down. Okay, and again, did it cost you anything? No, the money came from his money anyway. Right, he's financing his own mortgage insurance, and it doesn't cost you a single penny. That's the game changer for you folks. Okay, so just to reiterate and so you guys can have the visual. This is what you're currently doing, and all we're doing is changing the one account. Nothing else changes, right? And again, you get all these additional benefits. You get, and the mortgage, the private lender gets all these additional benefits. Okay, again, it's just amazing. Again, by changing one thing, what it's going to do for you. So here's,
Leonard, real quick, can I just,
yes.
everything's been so good, but I just thought maybe it might be a good moment to just kind of see if anybody has any questions that, because the video was, I mean, there was just a ton of information there. And then this is obviously applies to us as real estate investors. If anybody has anything that they would like answered. Because it is a lot to take in. It's good stuff.
It's a lot to take in. Yes, I know. Anybody have any questions?
Okay.
So Leonard, the 200K
Yes.
that went into the life insurance policy, is that something you could do, say, day one and then turn around and have the full 200K available? Or do you have to let that thing accumulate a cash value first?
Yeah, so again, so this is where some of the nuances come into play. So one, it doesn't work quite this perfect. 200,000, you put 200,000 into your policy. You do have access to a good portion of it from day one, okay, but not quite 200,000. Okay, so that was one of the little things that happened. But so in an ideal situation, especially on your first deal, we're gonna have to walk you through and figure out what is the best way to make it happen. But I would say starting from basically your second deal moving forward, it'll work exactly like this. So it's just the first deal that we would have to work through.
Then there was also a question of how much startup capital.
So that really it depends on, because this is insurance, so it still depends on your health, how much how much of a policy you can qualify for, all that stuff. So understanding that this policy, because of the way it's structured, again, not all insurance policies are created equal. Okay, that's the first thing I gotta say. I say this all the time. You can have another agent with my company that represents the exact same insurance companies, and we can design your policies completely different. Okay, so I want you guys to understand that this is a specific policy with specific riders, and it's funded a certain way to make this happen. But as far as how much capital do you need, it's gonna vary. This is not a cookie cutter strategy. It's gonna vary based on your scenario, your age, your health, how much money you got, all that kind of good fun stuff. And so that's where, again, when I sit down with you, we I have some questions. I have what is called a client questionnaire. Ask you a whole bunch of questions. Once I get that back from you, I go to work. I got to design the policy for you. We sit down, we run all the numbers, make sure it makes sense. You like it. If not, we play the what if game. Hey, what if I did this? What if I did that? What if we increase it? What if we decrease it? What if, all that good fun stuff. And then we move forward.
So Leonard, just to also add to that for Darnell, like this, so this strategy, Darnell, is basically taking funds from a private lender that you would normally use to fund your rehabs. So it's net zero out of pocket to the investor, because they're using OPM in several ways, right? You're using OPM from the private lender, and you're also using OPM from the insurance company. And OPM is other people's money.
Other people's money? Okay, yeah, I got it.
Yeah, correct.
I have a quick question. So I know this is obviously geared towards flippers, this diagram specifically. How does this change with buy and hold investors? How would this look? I mean, I think you answered it a little bit. Like we would sit down with you and go through and get a specific policy for our own goals. But how does it look different for buy and hold investors, someone who doesn't flip houses?
Yeah, so that I actually have a strategy for that as well. It looks completely different, right? Because you're more going the traditional route of getting a mortgage, but now you're using the income from the rental property you're going to put that back into the life insurance policy, and then from the life insurance policy, you're going to use that to pay your mortgage. So your money is still going to flow through the life insurance policy, but it's going to go the other way. It's going to go from the renter into your life insurance policy into your mortgage. The end result is going to be very similar. It just depends on, again, and this is where when we sit down, the first thing you're gonna have to tell me is, what kind of deals do you do? Do you do buy and hold, or do you fix and flip, or whatever? Do you do the burst strategy? What do you do, right? Because each however you do business, I can create a strategy that will fit the way you do business.
Yeah. So Nolan, if you're buying fixer uppers and you're fixing them up and then using them as rentals, and then your exit strategy is to get a mortgage on it, all of that gets factored in. And it just has to be designed and structured the right way. So it's very customized.
Got it. Thank you.
And
Good
thank you for letting me take that minute there, Leonard, and get some of these questions answered, because I knew, my own head, even after hearing this several times from you all, it still makes your head spin. So I appreciate that.
Oh yeah, wait till I get to the illustration. It's really going to make your head spin.
Love it.
Anybody else? I mean, because I love it. I love questions, man. Because questions it gives me a pulse on what you guys are thinking. So
Leonard, Steve just sent me a text. Have you spoken to Brandon at New Wealth about this strategy? So I'll answer it. Not yet. So we had a call with Brandon a couple days ago, but this strategy literally was just completed today. So you guys are hearing it first before anybody else.
I feel privileged that our group gets this benefit.
Yeah, and thank you for letting us share it here, because this is, phenomenal.
Leonard,
But,
real quick,
this is there's going to be when he shows the illustration, you're almost not going to believe it. So you just got to prepare yourself.
yeah,
It sound ridiculous.
it's ridiculous.
for this strategy, Leonard, how repetitive does this have to be? Is there a number that you have in mind, like how many times you have to do this in like a year?
Once a year. This is once a year.
Okay.
So if you like I said, for John and Laura, who's doing 55 a year.
I don't think I'd have my sanity if I had 55 looks going on. No, but thanks.
But yeah, if you're doing more, obviously, the number's going to change. This is just doing one flip a year. And actually, you know what? I'll even tell you the illustration that I'm about to show you, because of its limitations, I can only show one. The illustration is actually showing one flip every other year, but in reality, it's designed for one flip per year. Okay, so just know that what I'm able to show on the illustration, and it's what I'm trying to convey, two different things. It's not going to really match up. Okay, so here we go.
That's
Okay.
keeping it under the MEC and everything.
Oh yes. Okay, that was an insurance question for all of you that you didn't quite understand so what MEC is. We call it MEC, Modified Endowment Contract. Because we're using a life insurance policy, we are regulated to make sure that it meets IRS rules and regs, right? And so I want you guys to know that we're playing by the IRS's rules. Okay, we're not doing anything shady here. And so if you put in a penny more than the MEC or the MEC, it loses all of its taxable benefits. Okay, so when we structure these policies, we have to keep it below the MEC limits. So can only dip in. No, Naomi, you can do this. So again, depending on how you do, how you do your business, we'll structure it to the best we can, because there's a lot of limitations, especially in the beginning, on how we do it. Because again, if someone is, not able to, because this is a 3.2, I'm going to show you guys, it's a $3.2 million policy. Not everyone can qualify for a $3.2 million policy. So if you can't qualify for that, then it's there's got to be some other ways we have to work it and build up the equity inside of the policy and stuff like that. But then on the other hand, if you're able to qualify for a $10 million policy, well, you'll be able to do, a whole lot more. So it just depends on what your specific scenario is. But again, and if you're, if you're, let's say you can do one flip every 6 months. Well, the moment you put that $250,000 back into the policy, the very next day you can pull it out and do it again. Okay, so you're not limited. You're only limited to how fast can you get the money into the policy. And that's really, in these strategies, I will tell you guys, the biggest limitation, we call them buckets. Okay, the bigger the bucket, the more money is allowed to get into the bucket, which means more money is allowed to come out of the bucket. So the size of the bucket is what restricts us, and that's where the IRS has the chokehold. Okay, and so because we have to follow IRS rules, that we want to get the biggest bucket possible, so that it allows you to put more money in, but to get the biggest bucket possible is going to be based off your age, your health, your income, and a whole bunch of other stuff. Okay, so thank you. That was a good question.
Yeah, good questions.
Anybody else? Going once, going twice. All right, moving on.
So Leonard, can I just mention real quick
Yep.
that, so the beauty of life insurance policies is you're not limited to just one
Yes.
policy. You could have multiple policies. So if you start off at like a $2 million policy, and then a year or two later, you want to add another $2 or $3 million policy, you can do that. And then Bob Kane had a question of medical qualifications, question mark.
Yeah, so it just depends. I mean, we are, again, the bigger the policy, the more invasive the qualifications are. I like that. So, you know, if it's usually if it's $1 million or less and you're below 50, about 95% of the time there's we're going to ask you a whole bunch of questions, but you don't have to do a blood or urine test. The insurance company still has the ability to ask it and require it, but again, in most cases they don't. When we start getting into the $2, $3, $4, $5 million range, or you're above 50, then they start asking more questions, and they could require EKGs and stuff like that. So if you have medical issues, and of course we need to know about that prior to even moving forward, because we might have to shop it to a different company that is they have better more leniency on certain things, or we might have to just find a whole different strategy. I would say in most cases there's ways around things, but we would need to know that going into you know, moving before we move forward. Disabled vets, again, depending, I would tell you right off the bat, PTSD is a instant knockout. But again, like I said, there's other strategies. So you know, the beautiful thing about what I do is, and because this is not cookie cutter, we can find ways to make it happen, legal ways. I want to always emphasize we're doing it within the rules of the IRS code, and so it may require you, you know. Again, if you have a business partner, this is one nice way. Like I know Larry was partnering. I think it was with Bob. Is that, am I right, Larry? You and Bob have partners. You guys have are doing some JVs together.
It was with Larry was partnering with Jerry Britt.
Jerry, yes.
Yeah.
So in that scenario, if it was a company, let's say they set up an LLC to do business and to do their fix and flips, well, because they're partners, Larry can then take out a policy out on Jerry, and Jerry can take out a policy out on Larry. So there's ways around it. Okay, so it's not always I mean, it's we can get creative. Hopefully that answered your question, Bob.
So Leonard, Dr. Barbara had a question. Can you increase your current policy death benefit, say from 2 million to 5 million, or do you have to reapply?
You have to reapply. So at the time that we submit your policy, and this is why we do the best, you know, when we first going in, I will ask you a ton of questions, right? And part of it is to make sure that we want to get as close as possible to that bullseye, right? We'll rarely do we hit it perfectly on the first try, but we want to get close And then, like John said, if later on, a couple years down the road, now you're making more money, now we can go add on a second, third, fourth, fifth policy. I will tell you guys a good book to read is by Nelson Nash, Becoming Your Own Banker. Okay. Shoot, I just lost my book. Becoming Your Own Banker by Nelson Nash. He's actually, to me, the founder of all these different strategies. But when I met with him, I asked him, I said, how many policies he had, and this was back in like 2010. He had, at that time, he had 47 policies. 47. Now, understand, because he understood what he was doing, it wasn't about the death benefit. It was all created for this purpose. Okay, so again, just to get you guys
This is
wheels
actually on
turning.
my-
Yeah, there you go.
I've been listening to it. It's fascinating.
Yes, I read it every so often. About at least once a quarter, I read the book. Okay, so let's go into the design. So you can see this is actually pulled up the wrong one. We called him Flipping Freedom, right? Flipping for freedom, but anyway, it's Flipping Jack today. I'll change it later on. But again, this is a 45-year-old male in Florida. Okay, so we created this specifically for this presentation. As you can see, this is a $3.2 million policy with $200,000 annual premiums. So you can see every year he's putting in his $200,000 per year, and this is where the limitations of the software is. I can only show one flip every other year going in, but then the column left next to it, you can see we're paying the loan off $208,000. Okay, so again, limitations of the software doesn't allow me to do this every year, but we're putting in 200, we're paying it right off, taking another 200, paying it off, and so on and so forth. But at age 66, and again, want to clarify, it doesn't have to go to age 65. We're just doing it because that for this scenario, and this is what most people think what retirement is. So at age 65, he's done. Not a single penny goes into the policy. Oh, I'm skipping a thing. This is for you rehabbers, and this is what I was talking about earlier. As you're doing this strategy, at some point, you're going to have more than enough cash inside the policy that you won't need the private lender. So if you look here on this yellow box here on the right-hand side, in year 6, and actually, if you look even prior to that, in year 3, you already have $500,000 of available cash to you. This is liquid cash. Okay, so technically, in year 3, after you paid off that flip, you can then take $500,000 out of your own policy without a private lender. Okay, so let me play this out for you. You borrow that $500,000 from yourself at 4%. You're still earning 4% on the $500,000. So you're not even paying the 10% to the private lender anymore. You're making 4% on the $500,000 that you're borrowing. Okay, you use the 300 to purchase the house, 200 to rehab the property. You're not even making a monthly payment at this point. Your property, let's say your project goes overboard by another 3-4 months. Guess what? You didn't have to come out of pocket a penny to make up for that extension. And then when the project sells, you put all the money back into the policy, and you just wash, rinse, repeat again and again and again and again. Okay. So again, in year 6, you have now over $1 million in your policy. You can be doing 2 of these things a year, okay? And it's just going to multiply at that point moving forward. But now at age 66, he's done paying. But you can see now he's going to draw from his life insurance policy on about $568,000 of tax-free income every year for the rest of his life. Okay, that's every year. Because watch this, he's still not paying anything, and he's still drawing $568,000 tax-free income. We're not doing any more flips. We're done. Okay, we're just pulling money out of our life insurance policy to collect our cash, right? So he's now 70, 80 years old, turning 90, 100, and 110. He's still not paying anything. He's still collecting his $568,000. Watch this, at age 100, he still has a $600,000 death benefit, and he's already pulled out $21,699,000 out of his life insurance policy. How many homes would you need to own and manage to create $21,700 of tax-free income? That's tax-free. And again, if you believe taxes are going to go up in the next 20, 30 years, how much is that really worth? Right? Just for the fun of it, I like to show going to 120 years old, still not paying anything, still collecting $568,000. But watch this. You want to talk about leaving a legacy? Now your beneficiaries will get a check for $14.8 million tax-free. That is insane. And again, none of this cost you a single penny because it came from your private lenders, right? So here's the IRS codes that we like to show you. IRC 118 says death benefits are tax-free. 101G says living benefits are accelerated death benefits, therefore tax-free. 7702 says cash accumulation grows tax deferred. IRC 72 says policy loans are personal loans, therefore not taxable. And IRC 1035 says the owner may exchange an existing policy for a new one tax-free. Again, this is a game changer. We're playing by the rules of the IRS. We're just using a different vehicle. Again, I showed you guys all we did was exchange the bank for a policy. That's all we did. And this is the kind of stuff that we were able to do. So with that being said, my presentation is done. I'll turn it back over to you, Laura, and you can.
So, Leonard, we have a question from Paige. Hi, Paige.
Hey, Paige.
Asks, hi, Leonard, John, Laura, and everyone. You could use this money to then private lend on deals too, correct?
Yes, absolutely, 100% correct.
Yeah. So the beauty of having a group like what you guys have with Laura and John is, the more people in the group that gets, that sets themselves up with these kinds of accounts, now collectively as a group, you can basically become your own, financial ecosystem for each other's deals. So even though you're borrowing your money out at 4%, you can still lend it out at 10 or 12% and, just put that money back into your policy because you can turn around and take it back out and put it back to work again.
That makes sense. Becoming your own banker thing again, right?
Yes.
Your own banker or a banker for your friends instead of for PNC or America.
So Bob Kane says, let's buy a building.
Let's go. Let's
it.
go.
I like his vision. He's got good vision. So yeah, I mean, this is all incredible information. I know that one of the ladies that was on here had to go, but she wants to connect it with you all to talk further about this strategy. And I want to see if anybody else has any specific questions right now, and we can kind of go from there. There's been a lot of great questions that I know already answered or asked and then answered by y'all. It's just wrapping your head around, right? You're just doing what the bank does.
Yeah, so don't feel bad if it's kind of like it's a tough one to process the first time around. I had to hear the same information about 6 times before I could really like get it, right? But once you get it, you just, your whole mindset changes.
Correct. I know this is like, we've been talking about this, John, for how long now? And I think this is the 4th or 5th time I've heard it. And I still feel like I learned something new every time around, and really just, in my head, wrapping it around like what you actually was actually possible and obviously legal, which we all want to be. And just really utilizing, it's another way of utilizing another person's money. That's what we do with real estate, right? You utilize other people's money and you're just further utilizing it.
Yeah, 100%. And the thing that I love about it is that you get to put your entrepreneur and investor hat on. So the better you grasp how you can use this tool to your advantage, then it becomes really fun. Like this, what Leonard shared, I don't know if anybody's doing it like that. Like literally, when we got done with this today and we looked at those numbers, are like, No one's
A
gonna
lot of
believe
money.
it. I mean, $500,000 a year tax-free, but it's just math, right? So if you think about it, it's just the math of it.
That's an understanding the rules of the game.
Numbers don't lie. So in initiating the establishment of the account, what's the initial startup costs for the individual if you were to do this? Is it like a monthly startup, or you're basing it on the flip where you're getting the hard money loan and then you're taking that initial 200K and then dumping it in as deposit type of thing?
Again, it's going to vary based on everybody's situation. I mean, if you don't have a flip coming up, we can start it up as on a monthly, on a month-to-month basis. Just to see, the idea is you want to get the bucket ready to go before you get a deal, right? So you know where the money is going to go. And so initially it might be best to set it up on a month-to-month just to get get everything ready. But it's going to depend, because if somebody already has a deal coming up, or it's going to vary. And as far as the cost is going to, again, be based off of your age, your health, and your income, and some other factors. So it varies.
So I know you did that example off of a $200,000 premium. Are you able to, I mean, I know obviously go lower, but I guess if the premium's 200,000, what I'm trying to ask is, can you add more money than that into that account?
So that particular strategy, so where these policies thrive is when you max fund the policy. Okay, so you're gonna, if you start reading books and stuff like that, or listening to YouTube University, you're gonna always hear the term max funded policies, right? And so what we did in that actual illustration was the max you could put in was 203,000. So we took it right up to the limit. And so theoretically, no, you couldn't put. I mean, you could put a little more in there, but not much more. Yeah,
Okay.
We're gonna max it out.
Okay, that makes sense.
But with that being
In
said,
that
let's just say,
situation, is that where you would go and get a whole new policy then? If you have
right.
more? Okay.
Yes, but with that being said, if somebody says, well, I don't think I can come up with 200,000 in a year because my deals are smaller or whatever, I don't do as many deals. Well, if they can do 100,000 a year, well, I'm going to shrink the policy down to we want to max it at the 100,000 a year.
Okay.
Right. So it doesn't matter the size. Of course, we want to get the biggest bucket we can, but the biggest bucket that that you can max fund, because if you're not max funding it, then we're not utilizing, making the most potential out of it. With that being said, though, if hey, this is where I want to start, but I can qualify for this bigger bucket, but hey, in the beginning I can only start here, so I'm not going to max fund it. But we can still work with that, because another strategy we use is what we call backfill. And so let's just say just to keep the number simple, we start with this same policy, 200,000 a year, but you can only put in 100,000 for the first 3 years. Well, that means in year 4 on, that extra $100,000 that you didn't put into the policy the first 3 years, you can then put it in moving forward.
Okay.
So something to also keep in mind too with this strategy, when Leonard's talking about max funding, that's taking the rehab funds. That's the expenses to fund the policy. That doesn't account for the net profit when you finish the flip. That goes into another account, your business account. So this is just taking the bills and doing what Leonard just taught you. That to me is even more mind blowing.
Yeah.
Hey, Leonard, in that model, what was the minimum? Say you have a bad year, like what happens if,
Good question.
for the good, you know what I mean? Like, what's the minimum on that model?
On that one, the minimum was 36,000. So what he just asked again, he's one of my insurance guys. So he's asking all the insurance questions. So, again, as a real estate investor, you don't have the constant income. So what if you didn't have that great year? Well, so long as you came up with $36,000, the policy would be in play. But at some point as well, I mean, if you did this for, let's say 10 years and you couldn't come up with any, something happened where you couldn't do deals, well, the policy would be, would already be fully funded and you wouldn't have to put another penny into it.
Okay. That's a great question. That was a great question.
Yep. You smell smoke, Bob?
I'm watching Laura. It's the wheels are spinning. But so basically, so bottom line is, so there is a minimum annual requirement in order to maintain the account over time.
Yes, and again, there's ways around that as well.
Magic.
So what this is an index universal life policy, which is different than whole life. The IUL, what we call it, has the most flexibility. It's not as restrictive as whole life, and it has a lot more potential upside as well. The infinite banking concept is basically using a whole life policy. So.
I mean, does anybody else have anything else that they want to ask? And I know that these fine gentlemen, I know that they're always available for follow-ups as you process this, because I know that I'll continue to process it and ask lots of questions to them after the fact. I'm sure, they're available for y'all.
Yeah.
And those questions come available or come to you. And I know it was worth, John and I had just a separate call with them. It was a week ago, maybe. Time's just running together. And it was just helpful to look at exactly kind of what we do in our situation. And I know that they're great with that. So I guess if nobody else has any other questions, I really, really do appreciate both of you, Leonard and John, getting on this call and sharing the possibilities that are here. I know everybody has to make their own decisions for what's best for them, but this is just another avenue to really maximize, as you said, all the great benefits that you laid out on how this can make a difference in deals in real estate, and it can make a difference just in your own life and how we fund things. So again, much appreciated for your time today.
Yeah, thanks for
Appreciate you.
having us. And I dropped my email in there in case anybody has any questions they think about later and they want to ask. Feel free.
Awesome. Well, thank you all again for this evening. Much
Appreciate
appreciated. He's still, Leonard's in Hawaii. This is an evening for him. He's still got most of his day to go.
Yeah. He can still go to the beach.
Yeah, it's dark here. It's not fair, but anyway. Well, and
You still go to the beach. It's just dark.
that's true. I still could go to the beach. It's just dark. And maybe, yeah, I probably won't go then. A little unsafe.
I think it's like 87 degrees here, right, Leonard? It's about 87, 88 today.
Yeah, we're suffering.
It's hard. It's a hard,
We are blessed. We are
it's a
blessed.
hard knock life that somebody has to live, right?
Yes, we are blessed.
Our snow just melted.
Oh,
Yeah, I would
Just-
no, I
just
would not be
today.
surviving well in Pennsylvania if I was still living there. No.
So-
Snow becomes very old after the first time.
It definitely does. That's why we keep coming back to Florida as often as possible.
And we'll be back there next week. Is it next? Yeah, next week. We'll be there on the 24th. We'll be there. So yeah, if you guys want to meet up in person, let us know. Set it up.
Absolutely. It's always a pleasure to spend time with you guys. So would love that. Well, again, thank you. And y'all have a blessed week, and we'll hopefully I'll be in touch soon.
Sounds good. Aloha. Thanks.
Bye.
You guys,
All right.
take care.
aloha. Thank you.